what I'm going to do is I'm going to share the exact framework that we use for picking stocks for our clients. Without that framework, that's how people get caught up into the emotional uh, roller coaster that you can see from the noise of like social media, meme stocks, news headlines that create fear and doubt in your mind of what you own in your portfolio, and you know creating that uncertainty can be a costly mistake. So having this framework today is going to help you take and hopefully reduce and or eliminate some of that short-term market noise that you hear. So the step number one is looking at financial stability. That's one of our rules that we have when we look at stocks. And do you feel comfortable, I guess, investing in financially sound companies, or is it okay to try and jump into hot stocks that maybe are the topic of a recent social media ad? For us, buying hot stocks seems kind of appealing. It can be fun to talk about at a cocktail party or with some friends that you have, but it can be very risky just by chasing the hot stocks that are out there. If we look at things like some of the electronic vehicle companies, we had Fisker and Nikola both filed bankruptcy. So what was considered to be a hot company or hot area to get into, those two companies went out of business. There's kind of two ways that I feel an investor loses money when it comes to investing into the stock market. Number one is you buy an investment, it goes down in price, and then you sell that investment and you lock in a loss. And you do that because of an emotional decisions that you have about the company. That's one way that you lose money. Hopefully if you know what you own and you know the reason why you bought what you bought, if you look at when prices go down, that could create an opportunity, not a reason to panic. But the second way that you lose money is when you invest in a company and they file bankruptcy. I have a client, and he recently worked at Rite Aid. And as you know, Rite Aid had recently filed bankruptcy. So not only is that client now retired, whatever Rite Aid stock he had, say, in his 401k, because of the bankruptcy, is now really worthless. So those are two different ways. So when we look at it and we're looking at the companies that we have and we're looking at what companies do we want to invest into, for financial stability, what we're doing is we are looking at companies that typically have greater than 15% or greater than $1 billion of cash in their bank account. So that's one of the cash requirements for being financially sound. And then we also look for companies that have less than 30% in long-term debt. So cash-rich, low-debt companies are the financial stability ones. The second thing that we take a look at in this category is looking at companies that have a high profit margin. If you think about, say, the past 10 years, dividends can account for anywhere from 15 to 20% of the total return of the stock market. So investing in profitable companies can help put you in a basket of companies that have the potential to pay more in dividends. The difference between hoping and stock appreciation versus getting that regular income is a good way to look for those companies that have that 15% or greater return on equity margin. It shows that they're generating strong profits for shareholders' money. It means they could afford to be more consistent with their dividends than forcing you to hope for stock appreciation over time. Third thing that we're going to take a look at is we're going to look for companies that have a competitive advantage. So for the competitive advantage, we're going to look at companies that don't necessarily have to compete on price alone versus those that do. What happens when you have companies that have a competitive advantage, they typically can end up having better profit margins, and again, not just competing on price alone. That competitive advantage also can keep clients loyal even when some competitor offers a lower price, meaning that they have the ability to charge a premium and maintain higher profit margins without losing business to competitors. Then we're also going to look at companies that are what I would consider to be daily essential. The difference between companies that are the needs and wants. If we have tough economic times, there's certain bills like my housing, my transportation, my food, my energy, and utilities. These are all things that I'm going to pay regardless of what the economic conditions are. But then there's other things in other companies that are more of the wants category. And in the wants category, if times get tough, I don't need to take my family on a cruise next year. I could maybe do a staycation versus a vacation. Those are the type of companies that tend to be a little bit more risky when we get into economic tough times. So focusing on some of those daily essential companies can help when somebody has the ability to change what their discretionary spending is. And, think about the things that you're not going to cut when you go into a recession. Those can help provide some more stability as well. So again, if we look at the 5 formulas that we use here at the Retirement Guys Formula and rules for identifying financially strong companies, we want to look at companies that are, number one, cash rich. They have higher than $1 billion if they're a large company in the United States in cash. We want to look at companies that have low debt. They have less than 30% of long-term debt. We want to, third, look at companies that have greater than a 15% profit margin. Fourth, we want to look at companies that have a competitive advantage. And fifth, and/or, would be companies that are needed on a daily basis. And if you put all that combination together, it's going to allow you to take a look at, what you own and have a better understanding. You can go over, and there's some good websites that you can go to, like Morningstar. You could go to Yahoo Finance. If you don't know what you own, or if you want to find out, do the companies that you own currently, do they meet those 5 criteria? That's where Morningstar or Yahoo Finance will give you the data on those different companies that you own. Now, if you own like a mutual fund or you own an exchange-traded fund, it takes a little bit more research to truly find out what you'd own. You'd have to go and look at the portfolio and look at the actual holdings and then do the research that way. But those are 2 good tools, Morningstar and Yahoo Finance, to do the research. If you find that confusing and you still just want to know what you own, you can always get a hold of us here at America's Retirement Headquarters. Just ask us for an independent portfolio analysis. We can put that analysis together for you and send over exactly what you own in your portfolio so you'll know if your investments meet those 5 rules that we use here at Retirement Guys Formula.